Thank you. It's my pleasure to be here today, and of course the introduction was wonderful. I am a little tentative today because the last time I spoke to a group of people, there was an elderly lady in the front row, and she said, after I was making points, talking about things, talking about the market, supply and demand, and making a lot of points, she said, "Boy, you are a know-it-all son of a bitch." And I said to her, "Mom, that's a little harsh, don't you think?" So anyway, I have the privilege of giving the outlook today. And actually, 16 months ago, I gave a very bearish outlook, and the markets went down for 16 months. And in January, things turned around. The corn market had a nice upside reversal in January at the report day. And things are looking positive now. So I get to give a bullish talk. It's been 16 months, and so I'm looking forward to this today. Now, there's some negatives out there. There's some long-term pictures, and this shows the North Dakota marketing year average price. If you notice, there are 35 years from 71 to 2006. The highest spring wheat price was $471, soybeans $737, corn $316. And the lowest price we had since then, 2007 through 2012, and you can include 13 in there, was 2009. The lowest price was higher than the previous 35 years. So we've gone through 6 or 7 years of some very profitable periods in agriculture. We have a history, after we go through a period like that, we do suffer a bit. And so a lot of people are looking for more difficult times coming ahead. And I'm going to talk a little bit about USDA's outlook that they released, their long-term outlook, which was written in October, and it's not a very bright outlook, especially for corn and wheat. 2013, in review, we had prices go down fairly sharply, actually for about 16 months into January. From August of 2012, prices dropped. Chicago wheat, Kansas City wheat, Minneapolis wheat dropped from 22 to 26%, and that includes both the nearby month, the March contract, as well as Chicago July. That's July 14, and Kansas City 14, Minneapolis 14. They all had significant declines. So we don't have nearly as bright an outlook today as we had a year ago. Corn, we had old crop prices drop nearly 40%. New crop December went from $586 on January 1st of 13 to $450 on December of 13. We're sitting at about $464, $465 right now. Soybeans had a lot better performance, only down 7.5% in the nearby month. November down a little more, 13% or so. And you can see the numbers on soybean oil and meal. Meal, the positive sign. In livestock, a little better results. We actually have new highs in livestock recently. So the livestock outlook is fairly bright yet. In 2013, some of the other commodities suffered as well. The gold market was down 28% significantly, but actually I'll make a note, we ended December at 1202 or so. We're trading about 1320, so it's up 120 bucks in the last month and a half. Silver down 36% for the year, copper, platinum, palladium. In the one bright spot for commodities in 2013, as well as livestock, was crude oil. Crude oil actually went up 7% for the year. And, that's one of the reasons, if you combine that with a 40% drop in corn prices, ethanol profitability returned. And we have profitable ethanol plants, which is very positive for corn, of course. You can see the numbers for heating oil, ethanol, natural gas, of course, one plus 25%. This is a significant thing, I think. The Dow Jones Industrial Average in the stock market, the little broader index, the S&P 500, up from 26 to 29% in 2013. And look at that bottom CRB index. The CRB index down 11% for the year. The CRB index is an index of all commodities. And this is something that I'm a little concerned about, for a long-term picture, because from about 2006 until 2012, we had money pouring into commodities from the equity, from the New York big funds. They were pouring money into commodities. And commodities, for a period of years there, where we had commodities doubling, tripling, even quadrupling in price, they were the best investment on the planet. And these funds did a very adept job of identifying that and investing in commodities. But last year, we might have a change from that, where the CRB index actually was down 11%, even including the positive commodities like crude oil and the livestock. And the equities went up. So we might see over the next, could be 10, 20 years even, money flowing into the equities again and not so much money flowing into commodities. That might mean less volatility, but maybe less opportunity as well. So I'm not looking for commodities to be as volatile as we go forward if the funds stay out. So I talked about the stock market. We broke out to new highs. You look at this chart, that's a monthly continuation chart from 2005 forward, so about a 10-year chart. And you can see we had our high there, our big break, about 50% or more break, and we rallied all the way up and broke out to new highs just in the past year. So stocks broke out to new highs. There's the 10-year. That was the S&P 500 in the first chart. This is the Dow Jones Industrial Average. So a breakout to new highs when we broke above 14,000. There's a reason. The old saying is, close your eyes and buy new highs. And close your eyes and buy new highs. And so I think the funds are going to continue to pour money into these equities. In fact, I think the best investment on the planet might very well be the equities right now. So let's get more specific into corn, in the corn outlook. Corn issues. You know, 2012 we had a devastating drought in corn, 25% below trend yields, which is about once in every 3 or 4 decades type drought. You know, a 10% below trend yield is about a 5 or 10 year drought, and we had, one for the decades. So we recovered though in 2013. We ended up with 158.8 bushel crop. That actually wasn't equal to trend. It's a little below trend yields. Trend would be about 163 last year. But it was a recovery, and of course we had our dip in price from there. Demand the exports started relatively poor. We had some cancellations, but actually USDA in the February report cut ending stocks of corn 150 million bushels because our exports are forecast to be improving. And so the exports have been strong not only in corn, but in wheat and most especially soybeans, where we've sold more exports than we're forecast to deliver all of this year. So exports, we got the ethanol pace potentially slowing, and we've got experts in a panel here later on talking about EPA changing the renewable fuel standard. That's going to be coming up pretty quickly here. And USDA in their long-term outlook is assuming that that is going to happen. And I don't know what's going to, there are people who know more about that than me here, but that is going to affect the outlook. We had 1.6 million less soft red wheat acres planted last year. Usually it's wheat first, double crop to soybeans. If they didn't get the wheat in, it'll probably go to corn, so we might have a little problem with that. But I wanted to actually, you know, a lot of the news that we have out there, I think, is old news. You know, there was a reason why corn went from $6.50 on the new crop, December 13 market down to $4.25. We had over a $2 break in the market for a reason, and that was all the reasons I just talked about. But this is the ethanol margin as estimated by CARD, and this bottom part, this is the profitability of ethanol. You can see how we struggled in 2013. This is estimated to be the fixed costs of a plant. So here is how we have improved the profitability. Of course, energy prices are staying high and corn prices low. So the profitability of ethanol has turned positive. That's a very good thing for corn. And corn exports to date have been quite strong. We're 22 weeks into the corn marketing year, 30 weeks to go. Sales need to average 9.3 million bushels, shipments 34. But actually, we have USDA upping this export demand. We now are better than twice as much exports as we had last year. There was a lot of question, will demand rebound when corn prices get cheaper? And it's become quite apparent that USDA has underestimated that demand, and they've been constantly raising that export demand as we go forward, to the point where now we're down to people were talking 2 billion carry-out stocks at the end of this year, and now we're down to 1.4 billion in USDA's projections. So corn exports have been strong. And so we right now estimating ending stocks for this year at 1.481 billion bushels, about a stocks-to-use ratio of 11.1, and that's versus a 5-year average of about 11.2. So we have about an average stocks-to-use ratio for corn. Projecting prices to be $4.50 average this year, quite a bit down from the last 2 years, but still, you know, in a historical context, not too bad. Problem is, if you go forward and you start projecting next year's production, this is maybe a little too pessimistic. We've got a 2.6 billion carryout projected for next year, 92.5 million acres, a lot of assumptions here, a yield of 163 bushel. A lot of assumptions are put into this. This is probably the most pessimistic projection I think you'll see for the year. USDA, however, in their long-range projections, which they released last week, I think last Tuesday or Wednesday, they're going to update those on Thursday and Friday this week. But this was made as of November. They were projecting 93.5 million acres, 86.1 harvested. They're projecting a higher yield, 165.6 is their trend yield they're plugging in. So for a 14.26 billion bushel crop. They're leaving ethanol at 4.9 billion bushels, which is the same as this year. So expecting some slowdown, or actually just steady, not seeing growth anymore in the ethanol side. They're leaving a 2.6 billion bushel carryout, and their national average projected price was $3.65. Interesting, the target price in the new Farm Bill is $3.70, and USDA was projecting not just next year below $3.70, but the next 5 years projecting below that $3.70 target price. So they have a fairly negative outlook as they're going forward. The 2.6 billion carryout will be reduced 400 million bushels because the beginning stocks coming in won't be 1.8 billion, they're going to be 1.4 billion, and so that's going to get reduced when they update this next session now, later this week, to about 2.2 billion, not nearly as negative, and that is probably going to be the numbers they'll start, as they revise them on this Thursday, Friday. Those are the numbers that they'll use in May in projecting the 2014. They don't usually update those numbers between the February Ag Outlook report and May. So USDA's 10-year projections were very interesting to me. I noticed in 2006 and 7 and 8, USDA and those long-range projections constantly surprised analysts, myself included, with how optimistic they were for prices. And actually, they did a pretty decent job forecasting the boom in agriculture then. But they're not very optimistic now. The 2014 to 2018 forecast national average price for corn, $3.30 to $3.65, and then as we move into the latter part of the 10-year projections, $3.75 to $4.20. Break even now, USDA says, is around $4.14. So that is not a very optimistic projection by USDA. One of the guys in our office says, USDA is always negative, though. And typically they are, but during the boom times, they were a little more optimistic than people expected. Now, the target price in the new Farm Bill is $3.70, so that can have some implications again, can it? So looking at the charts, monthly corn chart, This is a 10-year chart. There's 2008. There's our 2012 run that actually went higher than 2008. We've had a significant drop since then. And look at this nice upside reversal on the monthly chart in January. The nice base. There should be support here at this level coming across. And of course, a lot of consolidation in that area between $4 and, what is that? Looks like about $3.50. So that's on the monthly chart. Just to give you a big picture, we've had a fairly stark downtrend, but we have a nice formation there, and hopefully we're breaking the downtrend on the longer term chart. The weekly chart looks a little more like we've got a bottom forming, in that we had this nice long downtrend, or terrible long downtrend, depending on your point of view, if you're a buyer or seller. And then we had this upside reversal in January, which I think was a very, very positive thing for the corn market, indicating a nice turnaround possible in corn. And since then, looking at, this is the March contract, and we took it around, and we actually have a nice long bottom, and there's that January crop report. We started out the day 4 or 5 cents lower. 11 o'clock, the crop report came out. People were expecting a 2 billion bushel carryout. It came out with like 1.8, 1.7, or 1.65, I think it was. And it was considerably less than expectations. We reversed and went 20 cents higher on the day. And since then, that looks like the turnaround in the corn market. So from January 11th on, we had a turnaround from being bearish corn, to we have new life and a possibility of a rally into spring. And I think this rally could continue longer than we expect. We might be able to get it. We've already got it up to this resistance mark around that 460. We might be able to get it up even into that, is that $5 area, I believe? So I think we've got a recovery coming into spring. I think it could last another 3 months. I'm not talking about a $2 recovery, but certainly a 50, 60 cent recovery is possible. After all, we lost 2 1/4 off the corn price on those new crop. You lost almost, we lost 40% during the year 2013. We lost a lot more on old crop prices, from $8 down to $4.50. So I think there is upside potential. We have good demand for corn. And all the negative news, maybe, when the January report came out, maybe all the negative news was in the market. Finally, after 16 months of going down, maybe finally, on that report day, we found out the surprise was the demand is better than we expected. The yields weren't as good in 2013 as some thought. And now we have a corn market that's going higher, if you look at the charts. I mean, that's clear. So December 14 corn, we've got that same upside reversal, and we've run up here to about 468, I think. We think between 465 and 535, there's a couple of points of resistance there. Those are good places to start making sales. We're actually at the 468 level today. And so I think that the corn market has a ways to go. It's rebounded quicker than we thought. So I think that means that the corn market has a little ways to go yet. But I think those would be some great sales levels for 2014 corn. I want to talk a little bit about South American weather. This is, of course, you've got Brazil on the north, you've got Argentina here in the south, and this was the percent of normal precipitation in January of 2014. You can see these dry areas developing. You can see this dry area developing in Argentina. They did develop some problems in January. As we move forward, this is percent of normal precipitation more focused on Argentina. Look at the large area of relatively dry weather in Argentina. Of course, there were wet areas too, but we did develop some areas that had yield reductions. USDA reduced Argentine corn and soybeans in the February report because of that dry weather in January. Temperatures were also warmer than normal over most of Argentina for the month of January. So we put some crop stress on the Argentine crop. I want you to notice, though this is the first week in February, northern Brazil continued to have cool, moderate temps and relatively frequent rain. And northern Brazil has a very good, northern and central Brazil have a very good crop this year, better than average. USDA raised the Brazilian soybean production 1 million metric ton in the last report. The first week in February, let me back up again. The first week in February, we did have a dry area. In this area, be southeastern Brazil and into some parts of Argentina, Paraguay. But the following week, this is the week of February 9th to the 15th, notice how that dry area had good rain. And so we're getting intermittent periods of dryness and rainfall in those southern South American production areas. So even though we've got production problems, it's not a major one. We've got, I would call them minor problems because we're getting intermittent rainfall. And look how that previously wet area, or previously dry area, is the next week got quite a bit of rainfall. You know, that's 1 inch to 3 inches of rain. So that is a positive for their crop development. Their forecasts, you know, I watch the forecasts. They update them twice a day, their weather models, and they have a 14-day forecast, which is as accurate as you can be in weather. So they had, this is the forecast from the 12th to the 20th, so we've got about this week, and this was the forecast the week after. It ebbs and flows and leaves out little dry periods, little dry pockets in parts of Argentina and parts of eastern Brazil, but intermittently you are getting rainfall. It is not a major type drought. I don't think the market is rallying right now on major problems in South America. So if you look at temperatures are forecast to be cooler than normal through most of Brazil, and we have intermittent in Argentina. This time, this was the 12th to the 20th, it was forecast to be a little cooler than normal. Now, today, if you looked at that updated, it's a little bit warmer than normal, but not, a significant problem. So I want to also talk about the U.S. soil moisture outlook. This is the U.S. Drought Monitor in March of 2013. Remember, we came off 2012. The whole United States was in a drought at the end of 2012, devastating drought. But from the fall to March, we had most of the eastern Corn Belt had their soil moisture problems solved by March. We still had a significantly affected drought area in the western Corn Belt. And so that was a concern in March of 2013. And that's one of the reasons the markets were still relatively strong in March. I think in February, we averaged last year $565 for our insurance-based price. So the March, as of that time in March, we still had prices that were fairly decent. This is the drought monitor as of February 4th of this year. Notice how much we have shrunk that drought area. We still have lingering areas of drought, some in southern Minnesota and Iowa and Nebraska, Kansas, Texas. But compared to last year, significantly smaller periods of drought. So our outlook is probably a little better this year, I think, than it was last year at this time. I like to talk about soybeans because most growers who raise corn also raise soybeans, so I'd like to talk a little bit about that. Some of the soybean probably has the best outlook right now. We had a nice pop in soybeans yesterday, 23 cents, and it's held most of those gains overnight. In South America, Brazil has a lot of acres, more acres. They're forecast to produce more soybeans than the United States this year. Early harvest, they estimate they're about 25%. Has been pretty good, but that harvest is in the north and the central now, That's where the best soybeans are in Brazil. So the South had some periods where they suffered. Argentina had some problems. U.S. demand, this I think is a big item. U.S. demand is impressively strong. Crush demand is strong, meal demand. And exports are very, very strong. And China has been huge. They're now up to 70% of our exports of soybeans. And they have been buying at a pace we cannot sustain. We've sold 1.58 billion bushels already. This was as of 22 weeks into the corn and soybean marketing year, 30 weeks to go. 1.51 is our projected exports for the whole year. We've already shipped 1.16, more than 2/3, and we've sold more than they projected, and we aren't even halfway into the year yet. So something has got to happen here, guys, in the next few months. We need to see cancellations outpace sales, and that's not happening. China is still buying more than they're canceling. They've started doing some canceling, but not on a large scale. So the United States does not have, we have 150 million bushel carryout projected in soybeans, and it's only there because that's pipeline supply. We don't have any more supply than that. So that might be what the market feels it needs to accomplish over the next few months. It needs to go up high enough to cause China to cancel more sales than they're purchasing. And we're not there yet, guys. This is a very, very positive thing for soybeans, and of course, that might carry over into the other markets as well. This shows the export destinations, and of course, you know what this growing line is China. You can see what they've done from 97 forward, just huge increases in soybean imports. So China is extremely important to us right now. So this shows the carryout numbers. Actually, carryout has been under 200 million bushels for 3 years running now. We're projected to have right back to 150 million bushel carryout. That is with a 43.3 bushel an acre crop. It was not a disaster in soybean production, as many thought. In August, the yields turned out better than expected. So USDA ended up reducing soybean yields in their August and September report, and then they skipped October, and then they ended up increasing in November and January to offset the declines they made in the fall. And so we ended up just about right where we were in August, 43.3 bushels per acre. We had 79.5 million acres, or 76.5 million acres of production, 150 million carryout. We've got, if you look forward to next year, a 234 million bushel carryout. That was on 79.5 million acres, but the USDA in their long-range forecasts of last November were forecasting 78 million. Our yield at 44.5 produces a 3.484 billion bushel crop. And of course, these are projections for next year. All of these are subject to change. You know, when we make projections for a year in advance, the interesting thing isn't whether you're going to be wrong somehow, it's how you're going to be wrong. Which of those numbers are subject to, question. And as you go through the season, of course, yield is the first thing. Planted acres is the first thing, I guess, and then yield comes under question. And then we start looking at the demand once we get into the production year, the shipping year. So USDA's baseline 2014 numbers for soybeans, I mentioned 1.5 million less acres than we're projecting, a 78 million acre increase. That's a 1.5 million acre increase, whereas I think it'll probably be closer to 3 million. Their yield is higher, 45.2 bushel an acre. They're forecasting about the same crop size, 3.48 billion bushel, a 203 million bushel carryout, but their beginning stocks need to be reduced 20 million bushels because we've lost 20 million bushels on that ending stocks carryout. It was 170 in November, now it's 150, so they're going to have to reduce that. We're going to be down to around 183 million bushels. National average price around $9.75. so considerably less than this current year. Their 10-year projections are not nearly as negative for soybeans as we've got for some of the other crops. 885 to 975 going forward from 2014 to 2021. 995 to 1015, 2022 to 24. Target price for soybeans in the Farm Bill is 840. So USDA is not forecasting us to fall below 840 in soybeans. You know, it's a little tough, you know, to look at a carryout projection for soybeans at 183 million bushels and corn at 2.2 billion for next year. Somewhere along the, that's more comfortable for corn. That's not very comfortable for soybeans. So somewhere between now and spring planting, we have a soybean corn ratio of about 2.5 right now. And so soybeans probably need to attract more acres, guys. They need to attract more acres, and they need to attract them away from corn and spring wheat and other crops. So I think that's a must for the market to accomplish into spring planting. Soybean monthly charts. Actually, this is the nearby monthly chart. We're still trading at about 1360 or so on the nearby chart. So we had our spike in 2008, a little down period, our spike back in 2012. But notice this chart doesn't have a long downtrend like corn does. And actually, if you look at this chart, I projected $11 is where the long-term monthly chart of soybeans probably needs to head. We hit $11 for new crop soybeans just in the past month or two. And that's been an interesting development in that does that mean that we have to hit $11 for new crop and old crop is never going to get there because we've got such strong demand for soybeans? That's possible because this monthly chart simply projects $11 sometime in the near future for soybeans. It doesn't mean old crop soybeans have to get there. It could be we just expire each of the old crop months and then we end up at $11 on the new crop soybeans. And that could happen. Here's the weekly continuation chart. We had nice consolidation in soybeans, a nice W formation, and actually we broke out above that and ran up to the 1360 mark. So we broke above that, out of that W formation to the upside in soybeans in the past week or so. And on the March futures, we had that W formation and bam, we broke above it. So we are trading. We have one more point of resistance here around 1380. And if we break that, guys, we might have some fireworks yet in the old crop soybean market. So, you know, we have an inverted soybean market. I think it's one you can sell cash beans, but actually it might be one with the market in a positive situation now where you want to replace that with some call options or some futures because the old crop does have potential as long as we continue to sell more soybeans than are canceled. And this is the November chart. Same W formation. We did break out to the upside on that as well. So we're running around 1140. There's some resistance there. But if we can get to 1165 to 1235, those would be our targets. You almost, as strong as the markets are right now, you almost want to lean toward the high side of those numbers as targets to sell. I think we have a positive market right now. The trends are up in corn, wheat, and soybeans. Corn turned first, soybeans second, and the wheat actually is up 70 cents in the last month. So we have positive things happening, especially on the export side of the markets. And that's a little bit of a bullish outlook as we go into spring. So I think we can run these markets up into spring. But if you look at the long-term picture, if the acres are going to be there, if we get the shift from corn and wheat to soybeans and get more comfortable stocks in soybeans, the long-term picture is not positive going all the way into new crop harvest. So I think this spring is going to be a sales opportunity, and we're going to have to take advantage of it in order to do a good job marketing this year. I Mark had mentioned some of the revenue rankings, so I just wanted to do a little bragging for Progressive Ag. We topped the market in 2014. This is by Top Producer Magazine. They rate marketing services. You can type in Google search and find it yourself. We topped it out in corn in 2012, but over the period we've been second if you go back to like a 2, 3, 4, 5 year, 7-year average. In soybeans we tend to do a little better, although in 2013 I think we did better in corn. We put a lot of hedges on in the fall of 2012 for 2013 corn. Those were some very good prices. We removed those hedges in the past month, mostly in the January period, and took over $2 profit in those things. So we're going to have a very good ranking in 2013. In soybeans, though, we sold aggressively as well. We topped it out in 2012. We tend to, when you get to a 4, 5, 6, 7-year average, we tend to do better in soybeans than all of those other marketing firms, and we're pretty proud of that, being mostly North Dakota and Minnesota farm kids making marketing recommendations here in Fargo, North Dakota. So that's something that we're very proud of. Soybeans, actually, if you're marketing soybeans today at the 1360 on the nearby charts, you're probably right at or above where we marketed 2013 soybeans. So it surprised me how strong soybeans have been, but that's what they are. So I'm not sure how much time we've got left. I've talked a lot about a lot of different things, and it's about 10 after 9. I don't know. I think I was scheduled to speak until about 9:15. There's a lot of things that can happen. This is the lull time usually for the marketplace. With normal yields in 2014, I think that we will be lower than we are right now, even at harvest time. But I am optimistic as we run into spring. We're going to have to look for the signal. Will this be an early spring? I don't know. The snow cover I was in Minnesota and Wisconsin over the last couple of weeks, and they have more than normal snow, considerably more than normal snow. Here in North Dakota, you look at fields and there isn't hardly any snow on the fields, actually. A lot of black showing. And so maybe we'll get an early spring in the western Corn Belt. The eastern Corn Belt has a little more snow to deal with. But I don't know what the weather's going to be like this spring. That's anybody's guess. Hopefully we don't have another awful spring like we had last year, where I think we got, 3 or 4 days of planting in May, maybe, it seemed like. So I noticed people are interested in planters that go 10 miles an hour if you have a year like last year again. So those are my comments that I've prepared for corn and soybeans. So if anybody wants to ask a few questions, I'd be happy to try and answer them if we've got time for a couple. So,
great.
Yep.
You talked about a 50-cent recovery in corn off of what level? Where we're at now? Or?
Well, we've already had about a 30-cent recovery. So, okay. Yeah, okay. Mike asked the question, we talk about a 50, 60-cent recovery in corn, and that was from what level? So, what were we at, 410 or so back then in January? We got a 20-cent recovery right away. Of course, we lost that, traded back and forth. We probably got a 30 or 40-cent recovery already. So I'm thinking another 20 or 30. It's been so quick. It's been so easy, it seems like. And the charts have turned. I'm thinking we might have another 20, 30 cents in it, at least.
Do you have a comment level about basis?
Basis levels. That's been a little bit disappointing. And the transportation issues. I think Ag Week magazine had a story about transportation being a problem. And, we have weak basis. The basis has been a problem. In Canada, one of my brokers talked to a producer up there, and his spring wheat basis at his local small elevator was minus $2. Minus $2 basis level. And they told him that they thought they might have room to bring grain in September sometime. That is terrible, terrible situation. It makes you wonder what the Canadians are going to do with the grain that they're unable to move. I don't know how locked up our borders are, but that could be a problem for our basis levels as we go forward if the Canadians are able to bring in a lot of grain. But our basis has suffered. Usually, of course, we get into springtime. April, May, we do get some basis recovery. So I think that we can still recover basis there. Soybean basis might end up being, very, very positive by the time we get into spring because we're simply going to run out of soybeans at that time. Any other questions? Yes, you, sir.
What do you foresee for LP prices by next fall, and what would be the possible effect on corn acres, if anybody's looking at that,
Okay.
that ratio? It raises another $1 propane compared to last fall, raise your cost per acre by 10, 12 bucks, something like that.
Okay.
That's what I think.
Okay, the question is on LP prices. Where do I think LP prices are going to go? Actually, it's astounding what they've done. And I wouldn't expect that. I would expect that by next fall, we will be able to solve some of those problems. I am no expert on LP prices. Energy prices have been remarkably strong too, though. The crude oil was up $2. Was it yesterday or the day before? Very strong energy prices yet. Of course, the crude oil is the big dog in it, but I would think that by next spring or by next fall, we'd be able to solve some of those LP problems, and we'd be able to get the LP prices down. I would think so. We should have time to do that. We had such a bitterly cold winter too, and along with drying corn, not just here but all the way down into Missouri and into the southern areas. So we dried an awful lot of corn, and it was pretty wet this year. Somebody else up in front had their hand up.
I want to look at the last slide, but you showed it, so.
Okay, last slide.
When does your weekly report come out?
Our weekly?
Yeah, you have a daily report, then you have a weekly report. When's the weekly?
Yes, we actually, okay, the question is, when does our daily and weekly reports come out? We write a market morning call every morning, and then we have like 4 or 5 pages that come out in the afternoon. That's our daily market commentary. For weekly, I usually write an article on Tuesday morning, and we write one on Friday that's in Ag Week, and on Tuesday morning, that's published in by agriculture.com. It's published in the green section in South Dakota, and of course, we publish it on our website. So that Tuesday is really fun article for me to write because I can write on anything, and it's fun to be able to just free fall and write on it. In Ag Week, we're pretty specific, writing about what prices did and why they did what they did. Yeah. Any other questions? Yes, sir.
On DTN, the few guys that I read, mostly are saying in another month South America is going to flood the market with beans, and that's going to be it. Do you have a concern along those lines?
The question was, a lot of commentators are saying that in a month that the South Americans are going to flood the market with beans. Is that a concern of mine as well? It is a concern. South America, I think, is going to have what I would call an average crop. Northern South America will be better than average. Southern had their problems, and we've trimmed it a bit. But South America better flood the market. They better be able to ship all of those beans to China, because China is buying way too many beans right now from the United States, beans that we do not have the supplies for, nor can we ship. So if we ship all those United States beans over to China, we're going to have to ship beans into the United States from South America. So in order to get by to the new crop harvest of the United States, we have tight supplies of soybeans. And the pace that China has been purchasing beans from the United States is not sustainable. We simply must have them cancel more of those purchases. So I think South America crop is there. I have heard, as the market, of course, broke out into an uptrend in soybeans, people talking about Brazil production being dropped to 87 million metric tons. I'm not in that camp. I think they still have a 90 million metric ton crop. I think they're going to have a good crop. And somehow, this is going to work itself out. But whenever you get very tight situation at the end of the United States marketing year, you can get a lot of volatility in a short period of time. And United States beans could get ridiculously, we could see some pretty significant gains, especially if we can break above that 1380 level in a very short period of time. And actually, if you look at what funds like to trade, a lot of traders in the market, they like to think about what the market needs to do. It's a little different thing to think about what the market needs to do, what it needs to accomplish. We need to get South America to supply those beans and get China to go there instead of the United States, and so far that's not happening in enough quantity. So the market probably will go up, and it will probably be a violent thing. I think that's why selling cash beans when you have an inverted market, the March contract's a premium to May, it's a premium to July. Selling the cash beans and buying a May futures or call option if you don't want any risk, or buying a July futures or call option at a discount is a good idea. And I think re-owning those beans for the time being, as long as we've got that trend higher. And you'll see cancellations every week. We get a sales projection on Thursday morning on what the weekly sales projections have been. You'll see when they start making big cancellations, and they're not making enough cancellations at this time. So it's a fairly, I hope I gave a fairly optimistic talk, because there is optimism. Grain prices, we went down 16 months, and we built in all that negativity into the market, I think. And I think the charts are showing that. And a fairly significant reversal on corn, the big dog in the marketplace, on January report day, when we get the final estimate for what happened in the 2013 crop. So we finally got, as big as the crop was in 2013, built into the market. We had all that negativity built in, and now our demand is kicking in at a better level than we expected. And so we have some optimism, I think, in the spring. Take advantage of it, make some sales. I would guess that time frame, May-June time frame, would be a great time to sell. And of course, you have to play the weather from there, how the weather is in the United States. So appreciate the opportunity to speak to you today, and I'll be around in the back of the room for a while. If you have any more questions, I'd be happy to try and answer them.